please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, here's the latest on the Mint Street then in the currency market. The Indian rupee firmed up yet again, most likely propped up by the dollar selling by RBI through banks. So the currency ended 21 paise higher at the 71.73 mark to the dollar in yesterday's closing. Now here's some macro data then. Current account deficit in the first quarter of the financial year has risen only by 5%, and this is largely thanks to Indians living abroad whose remittances have seen a sharp 17% rise. So trade deficit widened by 9%, and RBI's reserves, that is forex reserves, have depleted by over $11 billion between April and June. Lata Venkatesh is here with us to analyze this CAD data. Lata, not a big worry on the deficit front just yet.
Well, I would first of all want to point out that the current account deficit is not a problem in the first quarter. It's come in at 15.8 billion compared to 15 billion year ago, same quarter, 2.4% of GDP. Not alarming. But look at the number, 15.8. Largely, it is a small number because you had a very good private transfers. That's the big positive. About 19 billion, 17% rise from year ago levels, Indians living abroad and sending that money into India. The negative really is the trade deficit. The trade deficit is 29.9 billion compared to 26 billion year ago. Now, 29.9 billion is April, May, June. July alone, our trade deficit is 18.02. So watch, if it is 18 for every one of July, August and September, second quarter will be 54 billion compared to 29 billion in the previous quarter. That is what we have to worry about, not the trade deficit of the quarter gone by, but the trade deficit of the quarter that we are living through. We only have to hope that the rupee depreciation will increase exports and reduce imports, and we will not have a blowout 18 billion month after month. If we can restrict it to 1 or 2 months, we would be home. Coming to the current account deficit, coming to the capital flows, whatever the FDI gave us, 9.7 billion, was taken away by FPI for portfolio outflows. So net, we actually, our reserves reduced by 11.3 billion because the capital inflows were not enough to cover the current account deficit. Now we will have to see how we figure in the second quarter. Again, it's net outflows. FDI is coming in, but portfolio outflows are continuing. We will have to see a reversal of portfolio flows, either because the rupee is so cheap and India remains a growth story. Otherwise, we will continue to deplete our reserves. So those are the two red flags I want to point out. Trade deficit and this continual outflows on the portfolio account. If that were to continue, the reserves would start shrinking. We have enough reserves. We have $428 billion of reserves. But shrinking quarter after quarter is not a happy experience.